Before we begin, a quick disclaimer. I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and entertainment purposes only. It's designed to help you ask the right questions and understand your options, but it should not be considered financial or legal advice. Always consult with a qualified and licensed professional before making any decisions about your insurance coverage. You are almost certainly being overcharged for car insurance. I'm not talking about a few dollars. I'm talking about hundreds, maybe even $1,000 or more every single year. It's a quiet, perfectly legal fleecing of the American driver, and it happens because of one simple, powerful force: loyalty. You think being a loyal customer for 5, 10, even 15 years gets you a better deal? You are wrong. In the world of car insurance, loyalty is often punished, not rewarded. They call it price optimization. It's a fancy term for a simple algorithm that figures out the highest possible price you're willing to pay without complaining and leaving. They slowly creep your rate up year after year, counting on the fact that you're too busy, too confused, or too complacent to notice. They're betting that you won't do the one thing that could save you a fortune. Shop around with the right knowledge. Let me tell you about a guy named Mark from Ohio. Mark had been with the same big-name insurance company since he got his license at 16. 20 years. Not a single at-fault accident. He thought the small loyal customer discount he saw on his bill meant he was getting the best deal possible. Then, his neighbor, who drove a newer, more expensive car, mentioned he was paying almost half of what Mark was paying for insurance. Half. Mark was furious. He felt betrayed. But the truth is, the insurance company wasn't doing anything illegal. They were just capitalizing on his inertia. Mark's story isn't unique. It's happening in every state, to millions of drivers just like you. But that ends today. This isn't just another video with a few generic tips like drive safely or increase your deductible. I'm going to give you the 5 critical checkpoints, the 5 specific things you need to audit on your own policy that the insurance companies hope you never understand. We are going to pull back the curtain on the confusing jargon and the hidden clauses. By the end of this presentation, you will have a step-by-step battle plan to not just find cheaper insurance, but to find the right insurance for you, potentially slashing your bill by 30, 40, or even 50% without sacrificing an ounce of critical protection. So let's get started with the absolute foundation, the number one thing you must check before you do anything else. You need to truly understand what you are currently paying for. I know it sounds basic, but this is the step where 99% of people get it wrong. We treat buying car insurance like ordering a combo meal at a fast food restaurant. We just want the number one, the standard package, the recommended coverage. We see a bunch of confusing terms like bodily injury liability, comprehensive, and uninsured motorist. Our eyes glaze over, and we just click next, trusting that the insurance company has our best interests at heart. They don't. Their primary interest is their profit margin. Your standard package might be loaded with coverage you don't need, or, far more dangerously, it might be missing the one piece of coverage that could save you from financial ruin. So right now, I want you to do something. Pause this video if you have to, and pull up your current car insurance policy. Find the document called the Declarations page. This is your receipt. It's the one-page summary that lists every single coverage you have and exactly what you're paying for each one. Got it? Okay, let's decode it together. The first thing you'll see is probably the biggest and most important: liability coverage. This is the one part of your insurance that is legally required in nearly every state. But the state minimum is a trap. Let me repeat that. The state minimum is a trap. Liability coverage doesn't protect you or your car. It protects your assets. It pays for the damage you cause to other people and their property if an accident is your fault. It's broken into 2 parts: bodily injury and property damage. You'll see it written as a series of 3 numbers, like 25/50/25. This is insurance code. The first number is the maximum amount. In thousands, the policy will pay for injuries to a single person in an accident you cause. So 25 means $25,000. The second number is the maximum amount it will pay for all injuries in a single accident. 50 means $50,000 total, no matter how many people are hurt. The third number is the maximum it will pay for property damage. That's the other person's car, or maybe the mailbox or fence you hit. 25 means $25,000. Now imagine this. You're in a minor fender bender. You rear-end a brand new Escalade at a stoplight. The average new car price in the US is now over $48,000. Your state minimum $25,000 property damage limit? It's already exhausted. The other driver's insurance company will pay to fix their car. And then their lawyers will come after you personally for the remaining $23,000. They will garnish your wages. They will put a lien on your house. They will drain your savings account. All because you tried to save $12 a month by sticking with the state minimum. And that's just property damage. What if the people in the other car are seriously injured? A single night in the hospital can cost more than $50,000. If you injure 2 or 3 people, your $50,000 total bodily injury limit will be gone in an instant. You will be on the hook for hundreds of thousands of dollars in medical bills. This is how people lose everything. This is how one bad day on the road leads to bankruptcy. So what's the answer? You need to look for what I call the sleep well at night numbers. At a bare minimum, you should be looking for 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for all injuries, and 100,000 for property damage. The surprising part? The jump in cost from the pathetic state minimum to this level of real protection is often shockingly small. We're talking maybe $15 to $30 a month to increase your protection by hundreds of thousands of dollars. It is the single best investment you can make in your financial security. Look at your declarations page right now. If your numbers are low, circle them. That's your first target for a change. Next on your declarations page, you'll see collision and comprehensive coverage. This is the part that protects your car. Collision pays to repair or replace your car if you hit something. Another car, a pole, a guardrail, and it's your fault. Comprehensive covers almost everything else. Theft, vandalism, a tree branch falling on your roof, hitting a deer, hail damage, fire, flooding. For both of these, the key number to look at is your deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. A common deductible is $500 or $1,000. Here's the game. A lower deductible, like $250, means a higher monthly premium. A higher deductible, like $1,000 or even $2,000, means a lower monthly premium. The mistake people make is choosing a low deductible, just in case. They pay an extra $20 every single month for a $500 deductible instead of a $1,000 one. That's $240 a year they're spending to protect themselves from a potential $500 difference in an accident that may never happen. Your emergency fund should be your deductible. If you have at least $1,000 saved up, you should absolutely raise your deductible to $1,000. It's a guaranteed way to lower your bill immediately. But here's a pro tip. Do you even need these coverages? If you have a loan or a lease on your car, the answer is yes. The bank requires it. But if you own your car outright and it's an older car worth, say, only $3,000 or $4,000, you need to do the math. If your collision and comprehensive coverage costs you $600 a year, and your deductible is $1,000, you're paying a lot for a policy that might, at best, pay you a couple $1,000s if your car is totaled. It might be time to drop those coverages, bank the savings, and accept the risk of replacing the car yourself if something happens. Finally, look for 2 of the most criminally underrated coverages on your policy. Uninsured and underinsured motorist coverage, often abbreviated as UM/UIM. This is not optional. This is essential. A shocking 1 in 8 drivers in the United States is on the road right now with absolutely no insurance. That's more than 30 million people. If one of them plows into you and puts you in the hospital, their lack of responsibility becomes your nightmare. Who pays your medical bills? Who pays for your lost wages while you can't work? You do. Unless you have uninsured motorist coverage. This is the coverage that steps in and acts like the at-fault driver's insurance that they should have had. It protects you from the irresponsibility of others. Underinsured motorist is similar. It kicks in when the at-fault driver has insurance, but their cheap, state minimum policy isn't enough to cover your bills. Make sure your UM/UIM limits match your own liability limits. If you have 100/300 of liability, you should have 100/300 of UM/UIM. It's your shield. Don't go into battle without it. So take a hard look at that declarations page. You are now armed with the knowledge to see past the jargon. You know the state minimum is a trap. You know how to choose a smart deductible. And you know how crucial it is to protect yourself from the millions of uninsured drivers out there. This audit is the first, most critical step. Now that you know what a good policy actually looks like, we can move on to the next checkpoint. Finding the hidden discounts you're entitled to, but that your company will never volunteer to give you. Think of your insurance premium as a giant block of marble. The price you're quoted is the raw, uncarved block. The insurance company is perfectly happy to sell you the whole thing. But hidden inside that block is a much leaner, more affordable sculpture, your actual fair price. The discounts are the chisel, and you are the sculptor. But they don't hand you the chisel. You have to pick it up and start carving yourself. Most people believe their insurance company is looking out for them. They think that when they sign up, the company runs a little checklist and gives them all the price breaks they deserve. That is a dangerous and expensive fantasy. An insurance company is a business, and its primary legal and financial obligation is to its shareholders, not to you. Their goal is to maximize profit. A dollar they give you back in a discount is a dollar that doesn't go to their bottom line. So, while they are legally required to give you discounts you qualify for and ask about, they have almost zero incentive to go on a hunting expedition for you. You have to be the hunter. So let's load the metaphorical rifle and go hunting. We're going to break these discounts down into 3 main categories. Discounts about you, the driver. Discounts about your CAR, the vehicle. And discounts about your policy, the paperwork. Let's start with you, the person behind the wheel. The most common discount in this category is the good student discount. If you or a driver on your policy is in high school or college and maintains a B average or better, that's usually worth a 10 to 15% discount right there. But don't just assume they know your kid is an honor roll student. You have to send them the report card or transcript every semester. It's a little bit of work for a big payoff, especially with the sky-high rates for young drivers. Next, have you ever taken a defensive driving course? Most people think these are just for getting tickets dismissed. Wrong. Completing an approved defensive driving course can knock another 5 to 10% off your premium for 3 years. You can do these online in a single afternoon for about $25. You spend $25 in a few hours one time, and you could save hundreds over the next 3 years. The math on that is a no-brainer. Now for a big one that almost nobody thinks to ask about, affinity and professional discounts. Are you a teacher? A nurse? An engineer? A firefighter? A member of the military or a veteran? Are you a member of a university alumni association, a credit union, or even a wholesale club like Costco? Hundreds of organizations and professions have negotiated special group discounts with insurance carriers. Sometimes these are the biggest discounts available, even bigger than the safe driver discount. You need to make a list of every group, organization, and profession you belong to and ask your agent, specifically, do you offer an affinity discount for members of your organization? Don't just ask if they have discounts. Name them one by one. Okay, let's move on to category 2. Discounts about your car. This is where technology and safety features become your best friends. Your car is probably already packed with things that qualify for a discount. Anti-lock brakes? That's a discount. Airbags? That's a discount. Daytime running lights? Believe it or not, that's often a discount. But the most overlooked one is the anti-theft device discount. If your car has a passive alarm system, meaning it arms itself automatically when you lock the doors, that's a significant discount. If you have a vehicle recovery system like LoJack, that's an even bigger one. You can even get a small discount for getting your car's vehicle identification number, the VIN, etched onto your windows. A glass shop can do this for about $100, and it makes your car a much less attractive target for professional thieves, which insurance companies love. Think about it from their perspective. Anything that makes your car safer to drive or harder to steal reduces their risk. If you reduce their risk, you should get a piece of that savings. So, pull up your car's original window sticker online if you can find it, and look at all the safety and anti-theft features. Cross-reference that with your insurance company's list of available vehicle discounts. I can almost guarantee you'll find something you're not getting credit for. Finally, we have the third category, discounts on the policy itself. This is the administrative stuff, the way you pay and manage your account. And it's the easiest money you will ever save. The first and most famous is the bundling discount. Combining your auto insurance with your home or renter's insurance is almost always a guaranteed way to save, often up to 20% on both policies. But even if you don't bundle, there are still savings to be had. Are you getting your bills in the mail? Stop. Sign up for paperless billing. That's an instant discount. Are you paying your bill month to month? Stop. If you can afford to pay for the entire 6-month or 1-year policy upfront, do it. That's called a paid-in-full discount, and it can be substantial. They save on administrative costs and they get their money upfront, so they reward you for it. Can't swing the paid-in-full option? The next best thing is setting up automatic payments from your bank account or credit card. That's the EFT or autopay discount. And here's a sneaky one, the loyalty discount. It sounds great, but it's often a trap. They might give you a small 5% discount for being a customer for 3 years, but in that same time, they've likely raised your rates by 15% through a practice called price optimization. They slowly inch up the rates on loyal customers, betting you won't go through the hassle of shopping around. So while you should make sure you're getting the loyalty discount if you've been with them for a while, don't let it blind you to the fact that a new company might offer you a much better deal, even without it. Now let's put this all together with a quick story. Let's call her Sarah. Sarah works from home, drives a 2019 Honda CR-V, and has been with the same insurance company for 5 years. She considered herself a savvy consumer. She had a clean driving record and a bundling discount. She thought she was set, but after watching a video like this one, she got curious. She called her agent. She asked about a defensive driving course discount. She spent a Saturday afternoon online, got her certificate, and saved $120 a year. Then she remembered she was part of her university's alumni association. She asked about it. Boom! Another $80 a year. Her car had a factory-installed anti-theft system she never even thought about. She asked about that. Bam! Another $50 a year. But the big one was her mileage. Because she worked from home, she was driving less than 7,500 miles a year, but her policy still had her listed at the standard 12,000. By proving her low mileage with a couple of odometer photos, she qualified for a low mileage discount that saved her another $150. In one 30-minute phone call and one Saturday afternoon, Sarah saved over $400 a year without changing her coverage one bit. That's real money. That's a car payment. That's a weekend trip. That money was rightfully hers, but the company was just holding on to it, waiting for her to ask. So here is your mission. Your second checkpoint. I want you to get a piece of paper and draw 3 columns. Driver, vehicle, and policy. Go back through this part of the video and list every single discount I mentioned in the correct column. Good student, defensive driving, affinity groups, anti-theft, VIN etching, airbags, paperless, paid in full, auto pay. List them all. Then call your insurance provider. Be polite but be firm. Go through your list one by one and ask 2 questions for each. Am I currently receiving this discount? And if the answer is no, ask, what documentation do I need to provide to qualify for it? Do not hang up until you have gone through your entire list. This is the deep dive discount audit. This is how you take back control. You've now audited your coverage and you've audited your discounts. You're already miles ahead of 99% of drivers on the road. But we're just getting started. Because next, we need to talk about the single most misunderstood number on your entire policy. It's a number that creates a delicate and dangerous balance between your monthly premium and your financial risk. Get it wrong, and a simple fender bender could bankrupt you. Get it right, and you could unlock hundreds of dollars in additional savings per year. I'm talking about your deductible, and mastering it is the third critical checkpoint on our road to cheaper, better insurance. Think of your deductible as a seesaw. On one end, you have your monthly payment, your premium. On the other end, you have the deductible itself. When one goes up, the other must come down. This is the fundamental law of insurance physics. A higher deductible means you're telling the insurance company, hey, I'm willing to take on a little more of the initial risk myself. In return, they say, great, we trust you more. We'll charge you less every single month. Conversely, a low deductible has you saying, I want to be responsible for as little as possible in an accident. And the insurance company replies, no problem, but that peace of mind is going to cost you a lot, every single month, whether you have an accident or not. So what is the deductible exactly? It's the amount of money you have to pay out of your own pocket for a covered claim before your insurance company starts to pay. If you have a $500 deductible, and you get into an accident that causes $2,000 in damage to your car, you pay the first $500. Your insurer pays the remaining $1,500. Simple, right? But the choice of that number, 500, 1,000, maybe even 2,500, is one of the most financially significant decisions you'll make, and almost everyone gets it wrong. Why? Because we are wired to fear the big, sudden expense. The thought of having to suddenly come up with $1,000 after a crash is scary. So we fall into what I call the peace of mind fallacy. We choose a low deductible, maybe $250 or $500, because it feels safer. We pay a significantly higher premium every month for the comfort of knowing that if something happens, our out-of-pocket cost will be small. But what we're really doing is prepaying for a disaster that may never happen. It's like buying a lottery ticket in reverse. You're paying a guaranteed, recurring cost to avoid a potential future cost. And the math, my friends, is almost always a losing bet. Let's break this down with a real-world story. Meet two drivers, let's call them Chloe and David. They live in the same city, are the same age, and they both drive a 2021 Honda Civic. Their driving records are identical, spotless. The only difference is their philosophy on insurance. Chloe falls for the peace of mind fallacy. She's cautious. She chooses a policy with a low, $250 deductible for collision coverage. Her monthly premium for that policy is $150. She feels secure. David, on the other hand, has done his homework. He understands the seesaw. He asks the insurance company for a quote with a $1,000 deductible. The insurer sees him as a lower risk. He's not going to file a claim for every little scratch. His monthly premium comes back at just $100. So right off the bat, David is saving $50 a month. That's $600 a year. Every single year. Chloe is paying an extra $600 annually for the privilege of having a lower deductible. Now let's fast forward 2 years. Both Chloe and David have been accident-free. David is now $1,200 richer than Chloe. He took his $600 a year savings and put it into a high-yield savings account he labeled Car Emergency Fund. He's literally paying himself instead of the insurance company. Chloe, meanwhile, has paid an extra $1,200 in premiums for a benefit she never used. That money is just gone. But then, in year 3 it happens. Both Chloe and David, in separate incidents, back into a pole in a parking lot. It's the same minor accident, causing $2,000 in damage to their rear bumper. Let's look at Chloe's situation. She calls her insurance company, files a claim. She pays her $250 deductible. The insurance company pays the remaining $1,750. On the surface, this looks like a huge win. She paid $250 to fix a $2,000 problem. She feels validated. Her low deductible paid off. But did it? Over those 3 years, she paid an extra $1,800 in premiums compared to David. So, to get her $1,750 payout, she actually spent her $250 deductible plus the $1,800 in extra premiums. She is now out of pocket $2,050 for a $2,000 repair. She lost money. And that's before we even talk about her rates going up at renewal because she filed a claim. Now let's look at David. He has the same $2,000 repair bill. He calls his insurance. He has a $1,000 deductible. He could file a claim, pay the $1,000, and have insurance cover the other $1,000. But remember that Car Emergency Fund? He saved $1,800 over 3 years from his lower premiums. He looks at the situation strategically. He decides to pay the full $2,000 out of pocket, using the money he saved. Why would he do this? Because he knows filing a claim for a relatively small amount will likely increase his rates for the next 3 to 5 years, wiping out his savings. He uses the money the insurance company would have taken from him and keeps his record clean. He self-insured the damage with the money he saved. He beat the system. Even if he had filed the claim, he would have paid his $1,000 deductible from his $1,800 savings fund and still had $800 left over. In every scenario, David comes out ahead. The single most important question you must ask yourself when choosing a deductible is this: what is the highest amount I could comfortably pay tomorrow, out of my savings, without going into debt or financial distress? That amount is your ideal deductible. If you have $2,000 saved in an emergency fund, there is absolutely no reason to have a $500 deductible. You are essentially lighting money on fire every month. You are paying an insurance company to protect you from a risk you can afford to cover yourself. Raise your deductible to the highest level you can comfortably afford to pay from your emergency fund. For many people, this is $1,000. For some, it might be $1,500 or even $2,500. The premium savings can be astronomical. You're making a bet on yourself. The statistics are on your side. The average driver only files a collision claim once every 10 to 12 years. Are you willing to overpay for insurance for a decade, just to save a few $100s on one potential incident? It's a bad bet. Here's how to calculate your personal break-even point. Ask for quotes at different deductible levels. Let's say a $500 deductible costs you $50 more per month than a $1,000 deductible. That's $600 a year. The difference in deductible is $500. This means that in less than a year of being claim-free, you have saved more in premiums than the extra risk you took on. After that, every single month is pure profit in your pocket. And now for the pro-level tip that separates the amateurs from the masters. You don't have to have the same deductible for everything. Your policy is broken into parts. The two main ones are collision, which covers damage to your car from an accident with another vehicle or object, and comprehensive, which covers theft, vandalism, fire, hitting an animal, or weather-related damage like hail. Think about the risks. A collision claim is often your fault and can be very expensive. A comprehensive claim, like a rock cracking your windshield, is usually not your fault and is often less expensive. So why have the same deductible for both? You can set a high deductible for collision, say $1,000, to get those massive premium savings. But you can set a much lower deductible for comprehensive, maybe $250 or even $0 in some states. A cracked windshield is a common, annoying problem. Having a low comprehensive deductible lets you fix it cheaply without the massive premium costs associated with a low collision deductible. You are surgically managing your risk. You're protecting yourself from the common, inexpensive annoyances while saving a fortune by self-insuring against the rarer, major incidents. This is how you take control. Stop thinking of your deductible as just a random number on a page. It is the single most powerful lever you have to control your insurance costs. It's a conscious decision to self-insure the small stuff, to use your own savings as your first line of defense, and to reserve your insurance for what it was always intended for. True, unmanageable financial catastrophe. By making this one strategic shift, you stop being a passive bill payer and become an active manager of your own financial risk. You pay yourself first, building your own emergency fund instead of padding an insurance company's profits. And this mindset shift is crucial because it perfectly sets up our fourth critical checkpoint: the hidden discounts that insurers pray you'll never ask about. It's a fascinating psychological game, isn't it? Insurance companies spend billions on ads with friendly mascots and catchy jingles, all designed to make you feel like they're your helpful neighbor, your trusted partner. But when it comes to pricing, their business model relies on a simple fact. Most people will accept the first number they're given. They count on you not knowing the right questions to ask. They count on you not realizing that the sticker price is just a starting point, and the real price is hidden behind a wall of discounts you have to actively seek out and conquer. Think of it like a treasure map where the X is deliberately left off. Your job is to draw it in yourself. So let's start drawing. The first, and perhaps most overlooked, category of discounts is what I call the good character discounts. These are rewards for demonstrating responsibility in other areas of your life, which insurers then extrapolate to your driving habits. The classic example is the good student discount. If you're a full-time student, typically under the age of 25, and you maintain a B average or better, most major insurers will knock a significant percentage off your premium, sometimes as much as 15 or 20%. Why? Because the data shows that students who are responsible enough to keep their grades up are statistically less likely to be irresponsible behind the wheel. They're not just insuring your car, they're insuring your report card. So if you or your child on your policy qualifies, you need to be sending in that transcript. Not doing so is literally throwing away hundreds of dollars a year for an achievement you've already earned. But what if your school days are long behind you? The adult equivalent is the good driver or safe driver discount. Now, this goes way beyond just not having an accident for 3 years. In the modern era, this means proving your good behavior with data. This is where telematics comes in, the programs with names like Progressive Snapshot, State Farm's Drive Safe and Save, or Allstate's DriveWise. I know what you're thinking. The idea of a little plug-in device or a smartphone app monitoring your driving habits feels a bit creepy. Feels like Big Brother is riding shotgun. And that's exactly the hesitation insurers count on. But let's reframe it. You're not letting them spy on you. You're providing them with evidence. Evidence that you don't slam on your brakes, that you don't accelerate like you're at a drag race, that you don't swerve in and out of lanes, and that you don't typically drive late at night when most accidents happen. You are actively proving that their default risk assessment of you is wrong. For a genuinely safe driver, this is a golden opportunity. You are literally getting paid to demonstrate the good habits you already have. If your driving is smooth and predictable, the savings can be astronomical, sometimes cutting your premium by 30% or more after an initial evaluation period. It's a trade-off, yes, your data for their dollars. But if the data proves you're a low risk, it's a trade-off that can put a serious amount of cash back into your pocket. You just have to have the confidence to put your driving to the test. The next major treasure chest of discounts is for the loyal and bundled customer. This is the one you've probably heard of, but I guarantee you're not thinking about it correctly. Bundling is the simplest win in the entire insurance game. If you have renter's or homeowner's insurance with one company and your auto insurance with another, you are almost certainly overpaying. Insurers desperately want all of your business. It's cheaper for them to manage, and it makes you a stickier customer, less likely to leave. To get it, they offer huge multi-policy discounts. It's the Costco principle: buy in bulk and save. Combining your home or renter's policy with your auto insurance can easily save you 10 to 25% on both policies. It's a 2-for-1 deal on savings. But here's the critical twist they don't want you to know. While they reward you for bundling, their concept of loyalty is a double-edged sword. Yes, many companies offer a loyalty discount for staying with them for several years. It feels good, right? A little pat on the head for being a faithful customer. But this is often a psychological trick. That small 5% loyalty discount can make you feel appreciated and complacent, preventing you from looking elsewhere. Meanwhile, their rates may have crept up year after year, completely wiping out that discount and then some. This is called price optimization, a fancy term for charging loyal customers more because they know you're unlikely to shop around. The ultimate power move? Acknowledge the loyalty discount, thank them for it, and then get quotes from 5 other companies anyway. True loyalty in the insurance world shouldn't be to a company. It should be to your own wallet. Never assume your longtime insurer is still giving you the best deal. Loyalty is earned every renewal period, not taken for granted. Finally, we have the prepared and professional discounts. This category is all about proactive steps and affiliations you might not even realize are valuable. First, the defensive driving course. For a small investment of about $25 and a few hours of your time online, you can complete a state-approved defensive driving course. When you send that certificate of completion to your insurer, it can trigger a discount of 5 to 10% that lasts for 3 full years. The return on investment is massive. You're spending a little time and money to prove you're serious about safety, and they reward you for it. But the real hidden gem is affinity discounts. Insurance companies make deals with all sorts of large organizations to offer special rates to their members. Are you a member of an alumni association, a credit union, a professional organization for teachers, engineers, nurses, or lawyers? Are you active or retired military, a member of ARP or AAA? Even some large employers have corporate discount programs. You need to conduct an audit of your own life. Make a list of every single group, club, and association you belong to. Then when you're getting quotes, you ask the agent, "Do you offer a discount for members of your group here?" You would be shocked at how often the answer is yes. This is a scavenger hunt for savings, and most people don't even know they're supposed to be looking. And don't forget the easy stuff, the low-hanging fruit. Paying your 6-month or annual premium in full instead of monthly installments can often save you from service fees that add up. Signing up for autopay and paperless billing can each knock a few more bucks off. None of these are life-changing on their own. But you stack the good student discount on top of the bundling discount, add in a defensive driving course, find an affinity group you belong to, and pay in full. Suddenly, you're not talking about saving a few dollars. You're talking about cutting your insurance bill in half. This is the power they don't want you to have. The knowledge that your premium is not a fixed price, but a starting point for a negotiation you can almost always win. But even if you claim every single discount on this list, there's one massive factor that can either supercharge your savings or completely sabotage them. It's not your driving record, it's not the discounts you find, it's not even your credit score. It's the very metal, glass, and rubber sitting in your driveway. That's right, the car you drive is a secret weapon in this fight. And in the next part, we're going to show you exactly how to wield it. So how do you wield this weapon? First, you have to understand how the insurance company sees it. To them, your car isn't just a vehicle. It's a bundle of risks and liabilities, all wrapped in a steel cage. And they have a price tag for every single one of those risks. Let's start with the most obvious one, the sticker price. Imagine 2 identical drivers, Sarah and Tom. Sarah drives a brand new $60,000 luxury SUV. Tom drives a reliable 8-year-old sedan worth about 10 grand. If they both get into an accident and total their cars, who does the insurance company have to write a bigger check to? Sarah, of course. $60,000 versus 10. That massive difference in potential payout is directly reflected in their premiums from day one. It's the simplest rule in the book. The more your car is worth, the more it costs to insure because the more it costs to replace. But this is where most people stop thinking, and it's where you can get a huge edge. It's not just about the replacement cost, it's about the repair cost. This is the silent killer of affordable insurance. Think about a simple fender bender. 15 years ago, that meant a new piece of plastic, a little paint, maybe $500. Today, that same bumper on a new car is loaded with technology. It has parking sensors, blind spot monitors, cross-traffic alert systems. That little tap in the parking lot didn't just dent a bumper. It damaged a complex web of electronics. Now the repair isn't $500. It's $3,000 because after they replace the bumper, a technician has to spend hours recalibrating all those sensors so your car doesn't suddenly swerve into a ditch. And guess who pays for that inflated repair cost? You do, through a higher premium every single month. That windshield chip? If your car has a heads-up display or advanced driver assistance cameras mounted behind the glass, that's not a simple resin fix anymore. That's a full windshield replacement and a recalibration that can easily top $1,000. Insurers know this. They have databases that track the average repair cost for every single make and model. A Subaru Forester might have a lower sticker price than a BMW X3, but if its parts, especially its high-tech parts, are notoriously expensive to fix, that can close the insurance gap real quick. Before you buy a car, a quick online search for car model common repair costs can be the most profitable 5 minutes you spend all year. Next, your car has a secret reputation, and it's either helping you or hurting you. Insurance companies see it as either a boring, invisible car that thieves ignore, or a giant, flashing neon sign that says "Steal me." They have lists updated constantly of the most stolen vehicles in America. If you own a Ford F-150, a Honda Civic, or certain models of Kias and Hyundais that became infamous for their vulnerabilities, you are paying a theft tax on your insurance. The insurer looks at your car and calculates the statistical probability that one morning, you're going to walk outside and find an empty space where your car used to be. That risk gets baked directly into your rate. Conversely, if you drive a car that thieves just walk right past, maybe a Volvo or a Subaru, you're getting an invisible discount. They're not as flashy, but to an insurer, boring is beautiful. Boring is cheap. But it's not all doom and gloom. This is where you flip the script and use the car to your advantage. Your car's safety features are your personal army of discount-earning soldiers. We're talking about things like automatic emergency braking, blind spot monitoring, and lane keep assist. In the old days, you got a small discount for anti-lock brakes or airbags. That was it. Today, the game has changed. Why? Because these new systems don't just protect you in a crash. They actively prevent the crash from ever happening. Every time your car beeps to stop you from backing into a pole, or automatically brakes to avoid a rear-end collision, you just saved your insurance company thousands of dollars in a potential claim. They love this. They are so thrilled you're not costing them money that they will literally pay you for it in the form of a lower premium. They see a car loaded with modern safety tech not as a vehicle, but as a risk reduction machine. When you're shopping for a car, don't just see those features as cool gadgets. See them as annuities that pay you back every 6 months on your insurance bill. Finally, there's the fun tax. Insurance companies are the ultimate party poopers. They look at a car with a massive V8 engine, a turbocharger, and a spoiler on the back, and they don't see a thrilling driving experience. They see a statistical certainty. They know that a person who buys a 700 horsepower Dodge Hellcat is probably not driving it to the library at 25 miles per hour. They have decades of data showing that high-performance vehicles are involved in more frequent and more severe accidents. The engine size, the horsepower, the 0 to 60 time, every one of these is a data point that screams risk to their algorithm. A 25-year-old driving a sensible Toyota Camry could pay a fraction of what the exact same 25-year-old would pay for a Ford Mustang GT. It's the same driver, same record, same address. The only difference is the car. One whispers responsibility. The other screams, let's see what this thing can do. And the insurance company prices that scream accordingly. So you see, your car is telling a story to the insurance company before you even get behind the wheel. It's telling them how much it will cost to fix, how likely it is to be stolen, and how likely you are to wrap it around a telephone pole. By choosing a sensible, safe, and less stolen vehicle, you can slash your rates dramatically. But here's the crazy part. You could do all of that, you could pick the perfect car, the safest, most reliable, most boring car on the planet, and your rate could still be double what your friend in the next town overpays. Why? Because the most powerful factor we've discussed so far isn't the car in your driveway. It's the driveway itself. And where that driveway is located can either be your greatest ally or your most insidious enemy in the fight for cheap insurance. Let's unpack that. Your address, your 5-digit zip code, is a data goldmine for insurance companies. They don't just see a street name. They see a complex web of statistics, a probability matrix that tells them exactly how likely it is that your car, parked in your spot, will cost them money. It's not personal, it's purely statistical, and it's one of the most heavily weighted factors in your entire premium. Think of it like this. Imagine two identical twins. Let's call them Alex and Ben. They are the same age, have the exact same clean driving record, and they both just bought the exact same 2023 Toyota Camry. The only difference? Alex lives in a quiet, rural town in Idaho, while Ben lives in the heart of downtown Los Angeles. Alex's insurance quote comes in at $90 a month. Ben's quote for the identical car and identical driver? $350 a month. Ben is paying nearly 4 times more, not because of who he is, but simply because of where he is. Why the massive difference? Because insurance companies are masters of geography. They slice and dice the country not by state lines but by risk zones. And they are looking at 5 key geographical risks. First and most obviously is crime. They have access to incredibly detailed crime statistics, right down to the neighborhood level. They know which zip codes have high rates of auto theft. They know where vandalism and break-ins are common. If you live in an area where Honda Civics are stolen every other night, your premium for a Honda Civic is going to reflect that heightened risk. It doesn't matter if you have a locked garage and a guard dog. You are paying a risk tax based on the behavior of criminals in your area. Your policy is subsidizing the potential claims of your neighbors. The second factor is accident frequency. This is all about density and chaos. Ben in downtown LA is navigating a concrete jungle. He's dealing with 6-lane highways, constant stop-and-go traffic, tourists who don't know where they're going, and a much higher concentration of cars per square mile. The sheer number of interactions his car has with other vehicles, pedestrians, and cyclists every single day dramatically increases the statistical likelihood of an accident. Even a simple fender bender. Alex, back in rural Idaho, might only see a handful of cars on his commute. The roads are wide open. The chances of a collision are statistically minuscule in comparison. Insurers see this data not as city versus country, but as a raw number. The claims per mile driven in that specific territory. A higher number means a higher premium for everyone living there. Third, and this is one people often forget, is weather. Your location dictates your exposure to Mother Nature's wrath. If you live in Oklahoma's Tornado Alley, insurance companies know they're going to be paying out a ton of claims for hail damage. Those golf ball-sized ice cubes can total a car in minutes. So, the comprehensive portion of your insurance, the part that covers non-collision events, is going to be significantly more expensive. Live in Miami? They're pricing in the risk of hurricanes and flooding. Live in a mountainous region of Colorado? They're thinking about rock slides and severe snow. Live in Phoenix? The risk might be lower. This is why the same comprehensive coverage can cost twice as much in one state compared to another, even if the crime and accident rates are similar. The fourth geographical factor is a bit more inside baseball. Litigation rates. In certain parts of the country, people are simply more likely to hire a lawyer and sue after an accident. And in those same areas, juries tend to award much larger settlements for injuries. Insurance companies call these judicial hellholes. If you live in a zip code where a minor whiplash claim often turns into a 6-figure lawsuit, the bodily injury liability portion of your insurance is going to be astronomical. The insurer has to price in the risk of an expensive court battle for every single policyholder in that area. It's a hidden cost, baked into your rate, that has nothing to do with your driving and everything to do with the legal climate of your county. Finally, the fifth factor is the local cost of repair. It's simple economics. The cost to fix a dented bumper isn't the same everywhere. A body shop's rent in Brooklyn, New York, is going to be way higher than in Brooklyn, Iowa. The hourly labor rate for a certified mechanic in Silicon Valley is going to be more than one in rural Arkansas. The cost of parts, labor, and even the rental car the insurance company has to provide you while your car is in the shop, it all varies by location. Insurers have this data. They know the average claim cost for a rear-end collision in your zip code down to the dollar, and they adjust your premium accordingly. So what can you actually do with this information? Feels like you're powerless, right? You live where you live. But that's not entirely true. This knowledge is a powerful tool, especially if you're planning a move. Before you sign a lease or put an offer on a house, take 10 minutes and get a few car insurance quotes for that new address. You might find that moving just 2 miles away across a zip code boundary could save you $50, even $100 a month. That's $1,000 a year or more. That cheaper apartment in the next town over might not be so cheap, once you factor in the massive spike in your car insurance. This is a critical, often overlooked part of a moving budget. And be honest about your garaging address. That's the official term for where you primarily park your car overnight. It can be tempting to use your parents' address in a cheaper, rural zip code to save a few bucks while you live in the city. Don't do it. This is considered material misrepresentation, which is a form of insurance fraud. If you get into an accident and the insurance company discovers you lied about your address, they have every right to deny your claim entirely. You could be left with tens of thousands of dollars in medical bills and repair costs, all to save a little on your premium. It is a catastrophic gamble that is never, ever worth taking. So, your location is a story written in data, a story your insurer reads very carefully. It's a narrative of risk, compiled from crime reports, traffic patterns, weather charts, court records, and local economies. It's the invisible fence that defines the cost of your mobility. We've talked about the what, the car you drive. We've now covered the where, the place you park it. These are massive foundational pieces of the puzzle. But we still haven't touched on the most complex, the most influential, and frankly the most personal factor of them all. It's the one variable in this entire equation that you have the most direct control over, yet it's also the one that can be the hardest to change. We're talking about the person holding the keys, the driver. Your entire driving life, every turn, every stop, every single decision you've made behind the wheel, is written down in a story. And insurance companies are its most avid readers. This story is your driving record, and it is, without a doubt, the heavyweight champion of insurance rate factors. It's a living document that tells an insurer everything they need to know about the level of risk you represent every time you start your engine. Let's break down how they read this story. For a lucky few, the page is blank. A clean record. No speeding tickets, no at-fault accidents, no violations whatsoever. To an insurer, this isn't just a blank page. It's a masterpiece. It signals responsibility, caution, and predictability. Drivers with a pristine record are the gold standard. They unlock the best rates, gain access to preferred insurance companies that won't even quote high-risk drivers, and they're often the first to be offered perks like accident forgiveness. A clean record is like a financial superpower in the insurance world. But for most of us, the story has a few marks. Let's start with the most common. A speeding ticket. You're running late, you press the accelerator a little too hard, and you see the flashing lights in your rearview mirror. You pay the fine, maybe a couple $100s, and you think it's over. But that's just the prologue. The real cost of that ticket is written over the next 3 to 5 years. That single violation now lives on your record, and at your next renewal, your insurer's algorithm will see it. Flags you as a slightly higher risk. Maybe you're more prone to speeding. Maybe you're less attentive. The result? Your premium goes up. A single minor speeding ticket can increase your rates by 20 to 25%. If you're paying $1,000 a year, that's an extra $250. Multiply that by the 3 to 5 years it stays on your record, and that one $150 ticket has now cost you over $1,000 in additional premiums. The fine was just the down payment. Now let's escalate the drama. An at-fault accident. This is a major plot twist in your driving story. Not only are you dealing with the stress and potential costs of the accident itself, but you've now demonstrated a significant level of risk. You've cost an insurance company money. This is their biggest fear realized. A single at-fault accident can cause your rates to surge by 40, 50, or even 60%, and again that surcharge will follow you for years. Multiple accidents can make you nearly uninsurable in the standard market, forcing you into high-risk pools with astronomical premiums. And then there's the story's villain. A DUI or a DWI. This is a catastrophic event for your insurance profile. It's the ultimate red flag, signaling an extreme level of risk and poor judgment. Your current insurer will likely drop you at the first opportunity. Your rates will, without question, double or even triple. You'll be required to file an State Route 22 form, which is basically a certificate of financial responsibility that tells the state you have insurance, and it labels you as a high-risk driver to every company you apply to. A DUI is the single most damaging event that can happen to your driving record, with financial repercussions that can last for a decade. But your driving story doesn't have to be a tragedy. It can be a redemption story. If you have a few blemishes, you can take action. Many states and insurers offer the option to take a defensive driving course to dismiss a ticket or reduce the points on your license. This is a proactive step that shows insurers you're serious about improving. Some companies offer accident forgiveness, a get-out-of-jail-free card for your first at-fault accident, but you usually need to have a long, clean history with them first to earn it. And ultimately, the greatest editor of your driving story is time. As years pass, old violations fall off your record. A clean slate is always possible if you commit to safe, responsible driving. But the story of you, the driver, goes deeper than just your record. Insurers look at your demographic profile to build a more complete picture of risk, based on massive sets of data. Let's talk about age. There's no getting around it. Young drivers pay more. A lot more. A 16-year-old added to a family policy can easily double the premium. It feels unfair, but it's not personal. It's purely statistical. Per mile driven, teen drivers are nearly 3 times more likely than drivers 20 and over to be in a fatal crash. They lack experience in handling difficult situations, and their brains are still developing the part that manages risk assessment. The good news is there are ways to mitigate this. Good student discounts can shave off up to 25%. Completing a certified driver's education course helps. And as you age, your rates will naturally fall. With each year of clean driving, you prove the statistics wrong, and your premiums will reflect that, typically dropping significantly around age 25. Rates continue to decrease and then level out through your 30s, 40s, and 50s, which is often the sweet spot for the lowest premiums. You have decades of experience, and you're statistically in the safest demographic. As you move into your senior years, you might see a slight increase again, as statistics show a rise in accident frequency for very elderly drivers. Now for a factor that most people have no idea impacts their car insurance: your credit. Not your FICO score exactly, but something called a credit-based insurance score. Insurers are forbidden from looking at certain personal details, but in most states, they are allowed to use your credit history to generate this score. Why? Because decades of data from millions of people have shown a strong statistical correlation. People who manage their finances responsibly also tend to manage their driving responsibly. They're more likely to maintain their vehicles, pay their bills on time, and file fewer claims. It's a powerful predictor of future losses for the insurance company. This means that having a poor credit history, late payments, high debt collections, can quietly raise your insurance premiums, even if you've never had an accident in your life. Conversely, building a strong credit history by paying your bills on time, keeping your credit card balances low, and not opening too many new lines of credit at once can earn you a better insurance score and, therefore, a lower rate. This is one of the most powerful hidden levers you can pull to lower your costs. Improving your financial health can directly translate to savings on the road. Finally, insurers look at other life milestones as indicators of stability and risk. Marital status is a big one. Statistics show that married drivers file fewer claims than single drivers. As a result, married couples often enjoy rates that are 5 to 15% lower. Homeownership is another signal of stability. Owning a home suggests you're more settled, and it also unlocks the single biggest discount in the insurance world: the home and auto bundle, which we'll talk more about later. Even your education level and occupation can play a small role. Someone with a master's degree or who works as an engineer might get a slightly better rate because statistically, people in those groups have a lower claims frequency. So you see, it's not just about the car or where you park it. It's about you. Your history, your habits, your life choices. They all combine to create a risk profile. It's a story that's constantly being written, and every chapter matters. You are the main character, and the decisions you make, both behind the wheel and in your daily life, have a direct and profound impact on the price you pay. You have the pen in your hand. You can actively work to make your story one that insurance companies will reward. But what if you've done all of this? What if you have a great driving record, a solid credit score, and a stable life, but you still feel like you're paying too much? This is where the game changes, because having a great profile is only half the battle. The other half is knowing how to leverage it. There are dozens of hidden discounts, special programs, and strategic choices that most drivers never even know to ask for. These are the secrets that separate a good rate from an unbeatable one, and unlocking them is the next critical step. Let's start by reframing the word discount. Don't think of it as a coupon. Think of it as a reward. Insurance companies are constantly calculating risk, and they will literally pay you to be less of a risk. Your job is to prove to them in every way possible that you are exactly the kind of safe, predictable, and responsible client they are desperate to have. This isn't about haggling. It's about presenting a portfolio of your low-risk life. We can break these rewards down into 3 main categories. First, there are the discounts you earn through your actions and habits. Second are the discounts you get by making smart strategic choices. And third are the hidden gem discounts that you have to actively ask for. Let's start with the ones you earn. The most obvious one is the Good Driver or Safe Driver discount. This is the bedrock of savings. But here's what most people miss. It's not just one discount. It's often a tiered system. Being accident-free for 3 years might get you a 10% discount. But at 5 years, that could jump to 20% or even 25%. If you've had a clean record for years, you need to explicitly ask your agent, what is your maximum safe driver discount, and have I reached it? Don't assume they've automatically given you the top tier. Verify it. This single question can reveal you're being undervalued for your loyalty and safety. Next up is the Good Student discount. If you or a driver on your policy is in high school or a full-time college student with a B average or better, typically a 3.0 GPA, you are leaving a massive amount of money on the table if you don't claim this. Why do they care about grades? Because data shows a direct correlation between academic responsibility and driving responsibility. A student focused enough to get good grades is statistically less likely to be a reckless driver. Insurers see that B average not as a report card but as a risk assessment. To claim it, you just need a recent transcript or report card. It's one of the easiest and most significant discounts for families with young drivers, often slashing the notoriously high premium for teens by up to 15 or 20%. The third earned discount is the defensive driving course. You might think, I'm already a good driver, why do I need a course? Think of it as an investment with an immediate return. For a one-time cost of maybe $25 to $50 and a few hours of your time online, you can get a recurring discount of 5 to 10% on your policy for 3 straight years. Do the math. If your premium is $2,000 a year, a 10% discount is $200. Over 3 years, that's $600 back in your pocket for a $25 investment. That is an insane return. It's a certificate that literally says to your insurer, I am actively investing in being a safer driver. They love that. Now let's move to the second category. The discounts you get from strategic choices. The undisputed king of this category is the multi-policy discount, also known as bundling. This is the low-hanging fruit that, astonishingly, millions of people fail to pick. If you have your auto insurance with one company and your homeowner's or renter's insurance with another, you are almost certainly overpaying. Period. Insurers give their biggest discounts, we're talking 10, 15, even 25%, to clients who bundle. Why? Because it dramatically increases your stickiness. When your policies are intertwined, you're far less likely to shop around and leave them for a competitor. They are buying your loyalty. If you have a car and you rent or own a home, your first action item after watching this video should be to get a bundled quote. The savings are often so substantial that it's like getting your renter's insurance for free, and then some. Paired with this is the multi-car discount. It's the same logic. Insuring 2 or more vehicles with the same company proves you're a stable, committed customer. The company saves on administrative costs by managing one account instead of 2, and they pass a fraction of those savings on to you. It's almost always cheaper to have 2 cars on one policy than on 2 separate ones. The final strategic choice is about your vehicle itself. The car you choose to drive is one of the biggest factors in your premium. But beyond the make and model, it's the safety features that unlock specific discounts. Before you even talk to an agent, you should know your car's safety resume. Does it have anti-lock brakes? Airbags? What about electronic stability control? Does it have an anti-theft system like an alarm or a vehicle recovery device like LoJack? Each of these is a potential discount. Insurers have a checklist, and every box you can tick lowers your risk profile. A car that's harder to steal and safer in a crash means a lower chance of a big payout for them. You can often find a list of your car's specific features by entering your vehicle identification number, or VIN, into a free online decoder. Go into the conversation armed with this information. Don't wait for them to ask, tell them. Finally, we get to the third and most exciting category, the hidden gems. These are the pro-level discounts most people never know exist because they're not advertised on the front page of a website. You have to dig. You have to ask. The first is the affinity or group discount. This is a potential goldmine. Insurance companies make deals with large organizations, employers, universities, alumni associations, professional groups, credit unions, even wholesale clubs like Costco. They offer special discounted rates to the members of that group. Are you a member of the military, a veteran, or a federal employee? There are discounts for that. Are you a teacher, a nurse, a firefighter? There are discounts for that. Did you graduate from a particular university? Call your alumni association and ask if they have an insurance partner. You could be eligible for a significant discount simply because of where you work or where you went to school. This is one of the most underutilized savings strategies out there. Next, let's talk about how you use your car. If you have a long commute, you're a higher risk than someone who works from home. This brings us to the low mileage discount. If you drive less than the national average, which is around 12,000 miles per year, you need to declare this. Many people who now work remotely or have a hybrid schedule are driving thousands of miles less than they were a few years ago, but their insurance premium doesn't reflect that reality. Take an odometer reading. Calculate your annual mileage. If it's low, typically under 7,500 or 10,000 miles, you could qualify for a serious discount. This leads directly to the modern evolution of this concept: usage-based insurance through telematics. This is where you agree to let the insurance company monitor your driving habits, either through a small device you plug into your car or a smartphone app. It tracks things like your speed, how hard you brake, the time of day you drive, and your total mileage. Now, I know what you're thinking: privacy. And that is a valid concern you have to weigh for yourself. But for safe drivers, the savings can be astronomical, sometimes up to 40%. You are no longer being judged based on a demographic profile. You're being judged on your actual real-world driving. It's the ultimate way to prove you're a low risk. And finally, don't forget the small stuff. It all adds up. Opting for paperless billing can often knock a few dollars off each month. Setting up automatic payments from your bank account can do the same. Why? Because it guarantees they get their money on time every time, reducing their administrative hassle. Choosing to pay your premium in full for the 6-month or 1-year term, instead of monthly, can also save you a significant amount by avoiding installment fees. This isn't just a list of discounts. It's a blueprint. It's a series of levers you can pull to systematically lower your rate. By earning good driver status, making the strategic choice to bundle, and actively asking for the hidden gem discounts you're entitled to, you change the entire dynamic. You're no longer just a passive customer accepting a price. You are an active partner, building a profile that insurance companies have no choice but to reward with their absolute best rate. But even after you've secured every possible discount, there's one final, crucial element that can either solidify your savings or erase them entirely. It's the part of your policy that dictates what actually happens when disaster strikes. I'm talking about your deductibles and your coverage limits. These two things are the absolute heart and soul of your insurance policy. They are the financial levers that determine who pays for what and how much when things go wrong. Get this part wrong and all those discounts you fought for become completely meaningless. Let's start with the deductible. Think of it as your copay for a car crash. It's the amount of money you have to pay out of your own pocket for a claim before your insurance company steps in and pays a single dollar. If you have a $1,000 deductible and you cause an accident that results in $3,000 of damage to your car, you pay the first $1,000. Your insurance company then covers the remaining $2,000. Simple, right? But here's where it gets tricky. The deductible is the ultimate seesaw. When your deductible goes up, your monthly premium goes down. When your deductible goes down, your premium goes up. Insurance companies love when you choose a high deductible. Why? Because it means you have more skin in the game. You're less likely to file a small claim for a minor scrape or dent if you know you have to pay the first $1,000 yourself. It also reduces their financial exposure on every single claim. Because of this, they reward you with a lower price. A lot of people, in their quest for the absolute lowest monthly payment, will crank that deductible up as high as it will go. They'll choose a $1,500 or even a $2,000 deductible, see their premium drop by $40 a month, and think they just won the game. But what they've actually done is place a very risky bet. They're betting that they won't get into an accident. And while that's a bet we all hope to win, it's a financially devastating one to lose. Here is the single most important rule about your deductible. Do not choose a deductible that you cannot comfortably pay in cash tomorrow without derailing your life. Your deductible should be no higher than what you have readily available in your emergency fund. If you have a $1,000 deductible but only $300 in savings, you don't have a safety net. You have a financial trap. Because when that accident happens, and statistically it will happen to the average driver every 17.9 years, you will suddenly need to come up with $1,000. That could mean swiping a high-interest credit card, taking out a predatory loan, or being unable to repair your car at all, which could impact your ability to get to work and earn a living. The $500 you saved in premiums over the course of a year is instantly vaporized, and you're left in a much worse position. So before you select a deductible, look at your bank account. Be brutally honest with yourself. A lower $500 deductible might cost you an extra $20 or $30 a month, but that extra cost is buying you something incredibly valuable: peace of mind. It's buying you the certainty that a fender bender won't turn into a full-blown financial crisis. Now let's talk about the other side of the coin: coverage limits. If the deductible is the floor, the minimum you have to pay, then the coverage limits are the ceiling. This is the maximum amount your insurance company will pay out for a claim. And this, my friends, is where people make a life-altering mistake. In an effort to save a few bucks, they choose state minimum coverage, and in doing so, they expose themselves to potentially catastrophic financial ruin. Every state has a minimum amount of liability coverage you're legally required to carry. This is often expressed as a series of 3 numbers, like 25/50/25. It looks like confusing code, but it's actually simple. The first number is the maximum amount in thousands of dollars your policy will pay for bodily injury to a single person in an accident you cause. So 25 means $25,000. The second number is the maximum amount it will pay for bodily injury for the entire accident, no matter how many people are hurt. So 50 means $50,000 total. The third number is the maximum amount it will pay for property damage you cause in an accident. This is for the other person's car, or if you hit a fence, a mailbox, or a storefront. So 25 means $25,000. So 25/50/25. Sounds reasonable, right? It fulfills your legal obligation. But let's play out a scenario. A completely plausible, everyday scenario. You're driving in rush hour traffic. You glance down at your phone for just a second to check a notification. When you look up, the car in front of you, a brand new Tesla Model Y, has stopped short. You slam on the brakes, but it's too late. You rear-end them. It's not a high-speed crash, but it's a solid hit. Everyone seems okay at first. You exchange information. The damage doesn't look that bad. But then the bills start coming. The driver of the Tesla develops severe whiplash and back pain. They need physical therapy, chiropractor visits, and miss several weeks of work. Their medical bills and lost wages total $40,000. Your state minimum policy has a bodily injury limit of $25,000 per person. Your insurance pays that $25,000. You are now personally legally on the hook for the other $15,000. But wait, it gets worse. The Tesla had a passenger. They also have injuries, and their medical bills come to $30,000. Now, remember that second number in your 25/50/25 policy? The $50,000 limit per accident? Your insurance already paid $25,000 for the driver. That means there's only $25,000 left for the passenger. So the insurance pays that, and you are now personally responsible for the remaining $5,000 for the passenger. And we haven't even talked about the car yet. That not that bad damage to the Tesla? It turns out the collision damaged the battery pack, the rear sensors, and the liftgate. The repair bill is a staggering $35,000. What was your property damage limit? $25,000. Your insurance pays the $25,000. You are now on the hook for the other $10,000 to fix their car. Let's add it up. You are personally being sued for $15,000 for the driver, $5,000 for the passenger, and $10,000 for the car. That's a total of $30,000. Your affordable state minimum policy, the one that saved you maybe $15 a month, has just led to a $30,000 bill that could bankrupt you. They can and will go after your savings. They can garnish your wages. They can put a lien on your house. A 2-second glance at your phone has turned into a decade of financial hardship. This is not a scare tactic. This happens every single day in America. The cost of medical care and vehicles has skyrocketed, but state minimum coverage levels haven't kept up. Carrying state minimum insurance in 2024 is like trying to fight a forest fire with a water pistol. You are dangerously, profoundly underinsured. So what's the solution? You need to raise your limits. Most financial experts recommend a bare minimum of 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for injuries in an accident, and 100,000 for property damage. This provides a much more realistic layer of protection for the modern world. And here's the kicker. The price difference to go from a dangerously low 25/50/25 to a responsibly protected 100/300/100 is often shockingly small. We're talking maybe $20 to $50 a month. It is the single best investment you can make in your financial security. You are protecting your entire future, your house, your savings, everything you've worked for the price of a few fancy coffees. So when you're getting quotes, don't just look at the bottom line price. Compare the cost of state minimums versus a 100/300/100 policy. Compare a $1,000 deductible to a $500 one. The goal isn't just to find the cheapest piece of paper that makes you legal. The goal is to find true, affordable protection that won't fail you when you need it most. Because the cheapest policy can easily become the most expensive mistake of your life. But even with the perfect policy, the perfect deductibles, and the perfect limits, there's one last piece of the puzzle. It's the moment of truth that separates a good insurance company from a great one. It's what happens after the crash when you pick up the phone to make that call. Because the cheapest policy on paper can become the most expensive mistake of your life in that one single terrifying moment. This brings us to the fifth and final thing you absolutely must check: the company's claim satisfaction and customer service reputation. Think about it. You pay your premiums month after month, year after year. You are holding up your end of the bargain. The claims process is the moment the insurance company is supposed to hold up theirs. A low price is worthless if the company vanishes, argues, or lowballs you when you are at your most vulnerable, standing on the side of a highway with flashing lights in your rearview mirror. Let me paint you a picture. It's the tale of two drivers. Let's call them Alex and Ben. Both get into a similar, not-at-fault accident. Their cars are damaged, they're shaken up, but thankfully they're okay. Alex chose his insurance based on one thing and one thing only: the absolute lowest price he could find from a company he'd never heard of. He saves about $15 a month. He makes the call. He's put on hold for 45 minutes. When he finally gets a person, they're reading from a script, sounding completely disinterested. They tell him to fill out a form online. He does. He waits. Days turn into a week. He calls back. "Your claim is processing," they say. He needs the rental car to get to work. "That's not covered until we determine fault," they tell him, even though the police report clearly states the other driver was at fault. Another week goes by. An adjuster finally calls, but he's aggressive, questioning every detail of Alex's story. He offers a repair estimate that's $1,000 less than what two reputable body shops quoted. Alex is now not just dealing with the trauma of an accident. He's fighting a daily battle with his own insurance company. The $15 a month he saved now feels like an insult. The stress is costing him sleep, affecting his work, and straining his relationships. Now let's look at Ben. Ben paid $20 more a month for a company with a stellar reputation. He did his homework. He makes the call right from the accident scene. A real, empathetic human answers in under a minute. They ask first, "Are you safe? Is everyone okay?" They walk him through the next steps. They've already arranged for a tow truck. By the time he's home, he has an email with his claim number and the direct contact information for his dedicated claims agent. The next morning, his agent calls him. "We've already accepted liability based on the initial report," she says. "Your rental car is approved. Just go to the nearest enterprise, it's all set up. We've also scheduled an adjuster to see your car tomorrow at your home or office, whichever is easier for you." The repair estimate is fair. The check is sent directly to the body shop of his choice. The entire process is smooth, professional, and respectful. Ben is able to focus on what matters, getting his life back to normal. That $20 difference per month bought Ben peace of mind. It bought him a partner in his recovery, not an adversary. That is the true value of insurance. So how do you find out if a company is a Ben company or an Alex company before you have to make that call? You become a detective. And here are the 3 critical tools you're going to use. First, you look at the professionals. Your number one stop should be J.D. Power. For decades, they have been the gold standard for independent consumer ratings. Every year, they release 2 massive studies you need to look at: the U.S. Auto Insurance Study, which measures overall customer satisfaction, and the even more important U.S. Auto Claims Satisfaction Study. This isn't just a survey of a few dozen people. They survey tens of thousands of actual customers who have recently gone through the claims process. They rank companies on a 1,000-point scale based on things like the first notice of loss, the estimation process, the repair process, and the final settlement. Look up the companies you're considering. Are they among the best, better than most, or about average? If a company is consistently ranked in the bottom tier, that is a massive red flag, no matter how cheap their quote is. Second, you look at the official complaints. Every state has a Department of Insurance, and they all report data to a national organization called the NAIC, the National Association of Insurance Commissioners. The NAIC compiles all the verified consumer complaints against insurance companies and creates something called a complaint ratio. It's a simple, powerful number. A ratio of 1.0 is the national average. If a company has a ratio of 2.0, it means they receive twice as many complaints as the average company their size. If they have a ratio of 0.5, they get half as many. You can find this data on the NAIC website or often on your state's Department of Insurance site. Don't just look at the quote, look at the complaint ratio. If you're choosing between a company with a 0.4 ratio and one with a 3.1 ratio, you now have a data-driven reason to be very, very wary of the cheaper price. Third, you look at the patterns in public reviews. Go to Google, the Better Business Bureau Consumer Reports, but do it with a strategy. Don't just look at the star rating. Anyone can have a few angry customers. Instead, read the 1-star and 2-star reviews and look for patterns. Is everyone complaining about the same thing? They never answered the phone. My adjuster lowballed me and then ghosted me. The payout took 6 months. If you see a dozen different people from a dozen different states describing the exact same frustrating experience, you are looking at a systemic problem. That's not just a bad day. That's a bad company culture. So let's bring this all home. Finding the right car insurance isn't a one-step process. It's a 5-step strategy for financial security. Step 1 was understanding your coverage. You learn to look beyond the state minimums and protect your actual assets, your savings, your home, your future, with realistic liability limits and crucial additions like uninsured motorist coverage. Step 2 was hunting for discounts. You learn to be proactive, to ask about everything from good student and defensive driving discounts to bundling and telematics programs, turning your good habits into real, tangible savings. Step 3 was the power of shopping around. You committed to never settling for your renewal price, to using independent agents and online comparison tools to force companies to compete for your business, ensuring you never overpay. Step 4 was mastering the balance of deductibles and limits. You learned how to fine-tune your policy, raising your comprehensive and collision deductibles to a level your emergency fund can handle in order to lower your premium, while keeping your liability limits high to protect your wealth. And finally, Step 5 was investigating the claims experience. You now know how to use J.D. Power, the NAIC complaint ratio, and online reviews to look past the marketing and see how a company actually treats its customers when things go wrong. The goal was never just to find the cheapest piece of paper that makes you legal to drive. The goal is to find the best value. It's to find the perfect intersection of a price you can afford and protection you can trust. Car insurance is like a parachute. You buy it and you hope you never ever have to use it. But if that day comes, you don't want to be plummeting to the ground wondering if you bought the discount parachute that was stitched together in a basement. You want to know with absolute certainty that when you pull that cord, it is going to work. By following these 5 steps, you're not just buying a policy, you're buying confidence. You're buying the peace of mind that comes from knowing that if the worst happens, you've got a partner, not an obstacle. You've done the work, you've done the research, and you have made an empowered, intelligent financial decision that protects you, your family, and your future. Now go out there and get the protection you deserve.